you ever been tempted to sell your investments or change your risk level based on something you might have heard or read? Usually there's someone down the pub or something online who is very, very vocal about the fact that this time is different, or markets are at their peak right now and the only way to go from here is down. And don't get me wrong, sometimes these people will actually be correct. The whole nature of investing in stock markets is that they do go through periods when they go down as well as up. And while companies such as Octopus Money tends to be very vocal about the risks that come with investing, it's also really important that you understand the risks of disinvesting, or actually moving your savings from investments back into cash. Now, first things first, I want to be really clear about what this video is and isn't about. The whole purpose of investing and saving into pensions is so that at some point in the future, you actually get to spend that money on the things that you want to do. What this video is more focused on are any of those reasons that you might be tempted to sell that aren't based on your financial plan. Maybe you're planning to invest for another 5, maybe 10 years, but you've seen some really scary headlines and therefore think, I don't want to do this anymore. I would rather sell my investments back into cash. That's the real reason that we're looking at today, and I want you to just be absolutely clear about the risks that come with that if you choose to sell into cash at this time. And before taking a look at the data, I just want to reiterate that this is a really human reaction to all of the scary headlines or volatility that we see. It is totally natural to feel uncomfortable with our life savings fluctuating in value more aggressively than they might have done before. So don't feel like you're reacting in a different way. This is very, very natural. But the job of Octopus Money and myself is to make sure that you understand that these moments like these are really natural, and what we choose to do during them have a huge impact on our overall returns when we're looking at our financial plans. Risk number one of choosing to sell into cash based on fear or when markets are looking a little bit volatile is the fact that historically, when markets are really volatile, they tend to fall quite quickly, but they can, in many circumstances, not guaranteed, but what they can do is rebound very, very quickly. If we look back over the history of investing, many of markets' best single-day returns have happened during times of serious volatility. And so if we choose to sell into cash, we actually run the risk of missing out on those really high-performing days while still suffering those really bad days. Because often what will happen is we will see a drop in the value of our account, be really tempted to sell, and sometimes do so, and then in those days that might follow, we would miss out on any of those rebounds that would come in the value of your investments. In many ways, you're kind of sealing in any of the losses that you might have already experienced. Now, the impact of this on your long-term returns can be enormous and much, much bigger than you would otherwise imagine. So if we take an example of the FTSE All-Share, which is basically the UK stock market over the past 15 years or so, and if we had remained invested over that whole time, our average returns on an annual basis would have been about 7.7%. Pretty good, again, not guaranteed, important to keep in mind. If we had missed out on just the 10 best returning days over that 15-year period, then our average annual returns plummet from 7.7% down to about 4.6%. And so if we bring that to life, all that might have happened there 15 years ago is every time that markets got really volatile, and as a result we were tempted just to switch our investments into cash for a period of time, if that had happened on each of those best performing days, then our returns have fallen by over 2% every year as a result. Let's say we were actually slightly more nervous than that and we had missed out on the 20 best returning days. Then the difference is even bigger. All of a sudden, our annual returns have fallen from 7.7% all the way down to about 2.6% per year. Again, this is just the 20 best days that we've missed out on. And hopefully that really makes clear of the risk of choosing to disinvest, even if the intention is to do it for a short period of time, that can have on your long-term financial plans. And the final point to make on this kind of temptation around selling during times when markets are in a bit of turmoil is again to look back over history and recognise that every single occasion, a well-diversified bucket of investments has recovered from times when there has been market volatility. Now again, past performance is no guarantee of future, but if we take a look back at all of the major market events, I'm thinking about things like the COVID downturn, the 2008 financial crisis, the dot-com bubble bursting. After each of those, markets have always recovered. We don't know exactly when. During COVID, it took about 140 days. During something like the 2008 financial crisis, it took closer to 2 years for markets to recover. But as long as your financial plans are in a position where you don't really need to access that money for a good amount of time, then what can make a lot of sense is trying to wait and ride those times of volatility and wait for your returns to recover, as in the past they have. And so, to summarise, what should you be thinking about when markets are really, really volatile? I would always say focus on what is inside of your control. And the first of those is make sure you have your emergency fund in place. This makes sure if you have an unexpected expense, you know where you're going to get that money from your rainy day fund. The next thing I would think about is just check my financial plan once again. How long was I originally planning to invest for? If that continues to be for an extended period of time, try and stick to that plan. Whether markets are flying or falling, usually the best course of action is going to be to do nothing at all. And then the third point I would make is just check your risk level. Does it feel about right? If during these times of volatility you're really, really uncomfortable, that could be an indicator that your risk level isn't optimized for you. And so start having a conversation with someone, such as Octopus Money. We are on hand to try and make sure that the risk level is right and that you're thinking about things in the right way to achieve your future financial goals.